Reduced catastrophe losses in 2019 gave property casualty insurance results an overall underwriting and income boost. But challenges such as rising social inflation remain. I'm John Weber, here to discuss AM Best's latest review preview market segment report on the PC industry. Stefan Holzberger, AM Best Rating Services Chief Rating Officer. And Stefan, can you explain this social inflation dynamic and how it's impacting PC insurers?
Right, so sure, John. Social inflation, clearly bad news for underwriting profitability. It's getting a lot of attention in earnings calls. CEOs, C-suite executives are referencing this phenomenon of increasing loss severity as a result of social inflation. It is something that we're looking at very carefully. Really what goes along with this concept of social inflation is more claims being litigated, higher jury awards, claims that do not go to jury are settled for a higher amount. So, this level of severity is certainly something that's causing a concern to the P&C industry. It's affecting classes of business or lines of business such as commercial auto and GL, but also all the way to kind of smaller policies associated with personal lines, personal auto, for example. We're seeing a lot more attorney involvement, even with first-party claims. So, it is definitely something that we're looking at very carefully. Taking a step back from this concept of social inflation, we've had several years of soft market conditions in property and casualty, where over the last number of years rates have been soft. We've seen perhaps some optimistic accident year loss picks. So you have this dynamic of some kind of bad news coming through the market today, whether it's reserve increases or just lackluster underwriting performance across several lines of business. And it really kind of begs the question, how much of that bad news is really driven by what we call social inflation dynamics versus several years of soft market cycle kind of underwriting, risk selection, perhaps a bit of an erosion in underwriting discipline. I think time will tell overall which of the two is more the driver. Frankly, I think it's probably a combination of the two. What we'll be looking for are those outlier companies in a particular market that seem to be having an elevated loss experience or are taking that reserve charge when their peer companies are not.
Where does AM Best stand on the loss reserving practices of the industry? Are they adequate, or are you seeing deficiencies?
Right, so our analysis has, as of year-end 2019, a deficiency of roughly $34 billion. And out of that $34 billion deficiency, $20 billion is from the statutory discount, and another $12 billion is from A&E. So looking at core reserves, we're really seeing a very modest $1.2 billion deficiency, which, based on the size of the overall reserve balance for the P&C industry, we're really looking at about as close to reserve adequacy as you could get. Now, within that high-level number, you see certain lines of business that are redundant. So personal lines, workers' compensation, somewhere in the neighborhood of $7.5 billion in terms of a redundancy. And the other side of that, if you take GL and commercial auto, we estimate those two lines together to be running at about a $12.5 billion deficiency. So quite a disparity across various lines of business, but all in very close to reserve adequacy. I think the key thing to bear in mind, though, is really the trend. The trend is not positive. We're seeing more and more companies announcing reserve charges and adverse reserve development on recent accident years, and that's an issue today that is really not escalating all the way into a rating concern across the market. There may be some pockets of negative rating pressure tied to specific reserve charges, but it is something that we're going to watch very closely, because this could be in the early days of kind of ongoing news of reserve charges and reserve deficiencies across the market.
Are there any lines of business that AM Best is particularly concerned about? And conversely, are there any lines that represent some pleasant surprises?
Right, so let's start with the good news. Workers' compensation continues to be a positive story. We see, as I just mentioned, a fair amount of reserve redundancy in reported reserves in that line of business, and performance has been good despite several years of rate decreases. And really we see as the reason for that the improvement in data and analytics and predictive modeling that's really taken hold inside of workers' compensation in terms of a line of business. So those rate decreases are nowhere near as severe as they were during other soft parts of the cycle, prior soft market cycles. So we really see a level of underwriting discipline this time around for workers' comp, and that's benefiting results quite substantially. The other side of the coin, of course, is commercial auto, where despite several years of rate increases, the loss costs have just been outpacing those rate increases, and the performance continues to be poor, and we see ongoing reserve deficiencies in that class of business. It's, and that's kind of the overarching look across that line of business. There are some specialists in commercial auto and trucking, that's all they do, and their performance is really kind of an outlier on the positive side, where they're actually able to achieve pretty good results. It's more the national accounts that are highly competitive, quite volatile from an underwriting standpoint, and perhaps the largest commercial players that are writing package policies. That's where we see most of the poor performance, frankly, in the commercial auto sector. In addition to that, personal auto is such a huge line of business. We see roughly break-even results. Frequency continues to be down. Severity is up. And we all know the reason for that. The technology in these cars is just more and more sophisticated, and as a result, more and more expensive. But we see a bit of a reduction in rate increases in personal auto, so it's very likely that there's going to be a bit of pressure on the level of profitability they've been able to achieve. Two other lines of business probably worth mentioning. We've got negative outlooks on medical professional liability as well as professional lines, based partly on that social inflation aspect that we talked about, as well as several years of soft market pricing.
When it comes to the use of artificial intelligence and machine learning, is there any concern that insurers could have a difficult time explaining their underwriting decisions, and where's the transparency there?
Right, sure. So regulatory risk is a real thing. It's something that all P&C insurers in the market really need to keep an eye on and monitor that risk exposure in terms of the regulatory aspect. But that said, it is, although it is extremely important that your pricing, your risk selection, risk segmentation cannot be discriminatory. As you know, even in the market today, you don't have to be knowingly discriminatory. If it turns out that your pricing algorithms and your risk selection is discriminatory, it can be big trouble from a regulatory sanction standpoint. But at the same time, despite that risk, you see certain classes of business, personal auto being kind of the poster child, where very complex, very sophisticated pricing algorithms, risk selection, has really benefited that segment of the market. It's brought down the loss ratios over several years, and really to be competitive in that market, you need to have a complex, very kind of a fine-tuned underwriting algorithm and risk selection process to be competitive. Workers' compensation is another aspect where, through predictive analytics, we've seen so many cases of workers' comp companies bringing down their loss ratio and really improving their underwriting bottom line. So despite the regulatory risk, I think it's, you have to guard against that risk and handle it carefully, but the results, particularly in those classes of business, and we expect that to come more and more in other classes of business, it's something that's worth the effort. One final point on that front, with the data and the analytics, being so key, before all that can happen, you need to have the proper IT infrastructure, right? You have to have the systems. It's one thing to bring that data on board, but if you're running 10 different legacy systems, it's going to be very difficult to manipulate that data and do something with it. And then finally, the data itself, right? The quality of data is critical. If you're going to base your underwriting decisions on this data, some of which might not have that long of a history in terms of as an underwriting input, the quality of that data is key.
The underwriting bottom line that you just mentioned was profitable in 2019. Should we expect more of the same in 2020?
Yeah, I think our prediction is pretty much right around break even from an underwriting standpoint for the PC segment. We are seeing some good rate increases in casualty lines of business, some of those that I mentioned that have really been underperforming, where you've seen some adverse reserve development flow through. On the casualty side, we see some good rate increases coming through. Loss-affected property accounts, clearly seeing some strong rate increases in 2020. Reinsurance costs will be going up, are going up, so some of that profitability or improved rate environment, some of that's going to be shifted over to the reinsurance segment. But that said, we do feel like if we normalize for catastrophe losses, our break-even combined ratio expectation carries about 5 points for cat losses. That's come up over the last several years based on the frequency of severe nat cat events that we've seen. But if you normalize for the uncertainty of Mother Nature, we do feel that the industry should come in at right around break even for 2020. Couple that with a steady improvement and strengthening of risk-adjusted capitalization. We really do feel that P&C insurers are well placed to handle a difficult market from an underwriting side, and certainly uncertainty in the financial markets in an election year.
Thanks, Stefan.
Thank you.
You can find the full report online. For AM Best, I'm John Weber.